Every time the market climbs higher and higher, people start to feel unstoppable. Portfolios look great, headlines are positive, social media is full of screenshots showing big gains. It feels easy. And that's usually when trouble starts. So here's the big question. Is a stock market crash coming in 2026? Or is this just another wave of fear that will pass? Stay with me, because by the end of this video, you'll understand the real warning signs, what's different this time, and most importantly, what you can do right now to protect yourself without panic. Let's get into it. The truth is, crashes don't come out of nowhere. They feel sudden, but the signals usually build quietly in the background. Most people just don't notice them because everything still looks fine on the surface. Think back to the dot-com crash in 2000. The market was flying. Tech stocks felt unstoppable. Then the bubble burst. The Nasdaq Composite dropped almost 80% from its peak. That wasn't a small dip. That was life-changing for many investors. Then in 2008, during the global financial crisis, the S&P 500 fell more than 50%. People thought big banks were solid. They weren't prepared for what was coming. In 2020, when the pandemic hit, the market crashed at record speed. In just weeks, everything changed. So, what about 2026? Are we walking towards something similar? The market is expensive, but is it too expensive? One of the biggest warning signs before past crashes has been valuation. When stocks become very expensive compared to company earnings, it usually means expectations are extremely high. Right now, valuations are elevated compared to long-term averages. That doesn't mean a crash must happen, but it does mean the market is priced for strong growth. And when expectations are high, even small disappointments can cause big drops. This is what people often forget. Markets don't crash just because things are bad. They crash when reality doesn't match expectations. If companies grow slower than expected in 2026 or profits shrink, investors could suddenly rethink those high prices. And when that shift in thinking spreads, selling can accelerate fast. But here's the hook. Expensive markets can stay expensive for a long time. Just because something looks stretched doesn't mean it breaks tomorrow. So valuation alone isn't enough to predict a crash. We need to look deeper. Another huge factor is interest rates. For years, rates were extremely low. Cheap money helped stocks rise. Companies borrowed easily. Investors were willing to take more risk. But now, rates are much higher than they were during the 2010s. And that changes behavior. The Federal Reserve controls monetary policy in the United States. When it raises rates, borrowing becomes more expensive. When it cuts rates, money becomes cheaper. Here's something interesting from history. Markets often peak not when rates are rising fast, but when the Fed starts to slow down or reverse course. In 2000, the market topped shortly after tightening slowed. In 2008, the worst of the crash happened after rate cuts began. In 2020, emergency cuts signaled deeper problems. So the real question for 2026 isn't just, are rates high? It's, what is the direction of policy, and why? If inflation stays stubborn and rates remain high while growth slows, that puts pressure on businesses and consumers. On the other hand, if the Fed cuts aggressively, investors may ask, what's wrong with the economy? Either way, shifts in policy can shake confidence. And confidence is everything in the stock market. Right now, many economies are still growing. Job markets have been relatively stable. Consumer spending has held up better than expected, but economies move in cycles. Growth doesn't go up forever. If we move into 2026 with slowing job growth, weaker consumer spending, and falling company profits, that combination could create stress in the market. Crashes usually need a trigger. It could be rising unemployment. It could be corporate debt problems. It could be something unexpected, like a geopolitical event. No one can predict the exact trigger. But we can watch for pressure building. One thing to keep an eye on is corporate debt. When rates were low, companies borrowed heavily. If earnings slow while interest payments stay high, weaker companies may struggle. That's when cracks can start spreading. Now here's the part most people ignore. Markets are not just numbers. They are emotions. When everyone believes stocks can only go up, risk increases quietly. Investors start taking bigger bets. They ignore warning signs. They buy simply because prices are rising. Sound familiar? Before the dot-com crash, people believed the internet would change everything overnight. It did change the world, but not every company survived. Before 2008, people believed housing prices could never fall nationwide. That belief turned out to be very wrong. The danger zone isn't fear, it's extreme confidence. If we enter 2026 with heavy optimism, record margin debt, and widespread belief that this time is different, that's when caution makes sense. On the other hand, if investors are already nervous and defensive, the risk of a huge crash may actually be lower. Markets tend to surprise the majority. What makes 2026 different? Now let's talk about what's unique about this cycle. Technology is driving a large part of market gains again. Artificial intelligence, automation, and major tech companies are leading performance. When gains are concentrated in a small group of companies, markets can become fragile. If a few large stocks stumble, the entire index can feel it. Another factor is global tension. Political shifts, trade conflicts, and wars can impact markets quickly. We've seen how fast sentiment can change based on global events. But here's the key point. None of these guarantee a crash. They simply increase sensitivity. Think of it like dry grass. It doesn't mean there will be a fire. But if a spark appears, it can spread quickly. Could 2026 be a normal correction instead? Not every drop is a crash. Markets regularly fall 10% to 20%. That's called a correction. It feels scary, but it's normal. A true crash usually involves panic, forced selling, and deep economic damage. So when people ask, is a crash coming in 2026? We have to separate two possibilities. A correction? Very possible. Markets rarely move up in a straight line for years without a reset. A major 40% to 50% crash? That would likely require a serious economic shock or financial system problem. Right now, there isn't clear evidence of a crisis building at the same scale as 2008. Banks are better capitalized. Households are not as over-leveraged as they were during the housing bubble. But markets don't need a crisis as big as 2008 to fall hard. They just need a shift in confidence. The market rewards patience more than prediction. So instead of trying to guess the exact year everything falls apart, focus on building a portfolio that can survive storms and still grow over time. Because whether 2026 brings a crash, a correction, or another rally, the investors who stay calm and prepared will always have the advantage. And that's the real edge. Prepare. Don't panic.